Mr. Fred Chin, and ladies and gentlemen, both here in Pan Pacific, Singapore, and also online. It's really a great pleasure to be here to open the session for today. So I will just lay out some of the key risks, key factors, key drivers for your business to think about what to do and how to manage your risk that I think Mr. Fred Chin just now talked about quite a bit already. Some of these factors here. My name is Tekin. I'm from UOB Economic Research and Market Research. I run the team here, and today, later, we have some other colleagues to run through the forum as well, the panels, to discuss some of the key things. So for now, I will just we look at some of the key drivers. What are the key drivers ahead? And what are the implications for your business? And what are the risk management measures that our colleagues here from the team, for example, Eileen is sitting here, and her team, how can she help you to manage your risk? All right, so what are the key drivers? I put up 5 key drivers up here. They all start with R, and from short to long. And you can see that all the R's down here, the first 3 R's, most likely will have some implications on market volatility that Mr. Fred Chin talked about as well. And then the bottom 2 R's have a bit more long-term impact, a bit more structural impact, kind of like a shifting sense, rather than all these huge volatility that we have seen in the past year. All right, oops, let me go back. So first one is your rates, all your rates you're talking about, for the past year or so. Inflation rate, interest rate, exchange rate, and then inflation rate, of course. And recession risk is the next R, occupying quite a bit of, I think, people's mind. What to do with the recession coming? Is it a serious one? Is it a short one? And is there going to be a deep one? I have some pointers for you to look at some of the key items. And then, of course, the Russia-Ukraine conflict, there's something that I think really beyond our control, but it does have an impact on commodities prices. And then return to normalcy for China, and what are the impact for us? What kind of impact are we going to see in our part of the world? And the last one, regionalization, deglobalization, that Mr. Fred Chin also touched on in his opening speech. All right, so first one, interest rate. I think this one, is open to everybody's, interpretation or expectation. In terms of the Fed funds rate, what we are looking at is for the Fed funds rate to top out at about 5.25% for this year, and then hold there for the rest of the year of 2023. Now, Fed funds rate, right now, at the last meeting in December, is 4.5%. Right, last year, the Fed, very aggressive, can see from this line here, compared to the previous vertical line that happened in the past, is a really aggressive rate hikes policy that the Fed has adopted. So now, we expect 5.25%. It's open to argument, of course. 5%, 5.25, is it going to be higher? And that will be determined by later another chart that will show you whether this is going to be 5.25, 5.5, 6, or lower. Right? So some of the key things that we can watch out to determine or to think about where this Fed funds rate is going to go. So 5.25 is the one that we are having right now. In February, there will be another FOMC meeting, 50 basis points. Some argue 25. Depends on the number that will be coming out soon. And also in March, there's another FOMC meeting, 25 basis points. All right, so this basically the stage that we set for this year. Interest rate heading higher. All right. So all this Fed policy, all this aggressive Fed policy actually has a huge implication on the market that we saw last year. Mr. Fred Chin talked about that earlier in terms of the ADXY, the DXY, the dollar index, the Asian dollar index. For example, you can see on the top, that's a US dollar index. As the Fed raised interest rate, the market expectations built in. So you saw a volatile year last year in terms of exchange rate, right, the US dollar. And the other related implication is the Asian dollar index. Asian dollar as a whole fell 6.5% last year, or so, 6-point-something% last year. And that's the worst performance since the Lehman Brothers crisis, global financial crisis in 2008. That's the worst performance. So you can see that if you are importing, you are importer, so you are subject to this sort of volatility. And is it going to stop this year? No, it's not going to stop this year. It's going to continue. So that's the reason why it's important to continue to manage your risk. It's important to use whatever tools that you have. Like, for example, UOB will be able to help you with the solutions to manage your risk for this sort of volatility. It's not going to end. For example, I think the bottom line, the orange line at the bottom, I think people will be very excited about this, right? People were excited about this. Look at the Japanese yen. Fell as much as 20% last year. So those who bought, those who follow our FX insights, they will have an idea where these, we publish our FX insights every day, so they will have an idea to follow very closely when to come in. Right? October was a low point, and that's what happened for the Japanese yen. People buy, they go travel to Japan, right, to have they enjoy the holidays there. So, but it has already recovered quite a bit from the low point in October. So again, the volatility is here to stay. So we do have to keep in mind when we manage our business. All right, the other one, what to look out for this Fed interest rate, 5.25 whatever percent. One of the key things that drive the Fed's thinking, is the inflation. This complicated chart on the screen. This inflation chart. So what is there to, what should we be looking at when we receive the report? Thursday, 12 Jan, tomorrow evening, we'll receive going to see the latest CPI report. So what is that? What should we be looking at? What should we be looking out for? One of the things that you should be looking out for in that report is the month-on-month movement of the index. Right? That will be driving the Fed's thinking. For example, you have the Fed speaker coming out to say that, oh, it's going to hit 3-something% by the end of this year, 2023, for the inflation. So where do they get this kind of idea from, or thinking? How should we interpret that? So the important thing is that, for example, the latest number is 0.1% month-on-month, right, for November. The top number, year-on-year, compared to last year, the number is going to come down. That number is going to come down because of the base. So when you see the number coming down, you should not be surprised. The number coming up because of the base effect. But the important thing to look at when you receive the report tomorrow is and the subsequent report is the month-on-month number. Now, the latest one is the 0.1% month-on-month. In the past, if you look back at the past, that's the average movement for the inflation rate in the US. For the past 20 years, before COVID, 0.1% on average. Right? So that's what happened. But in 2021 and 2022, the number on average has gone up to 0.6% on average every month. So there's a huge jump. And that's a contribution to the huge jump in your year-on-year figure. So the important thing when you receive the report is to see where the month-on-month report is going, where the month-on-month number is going. Now, if you follow this 0.1% all the way, assume that 0.1% will happen for the rest of the year, by end of this year, the headline inflation will hit 1.2%. All right, so is it going to happen? Is it likely? Well, let's look at some kind of scenario. For example, if you hover around 0.1 to 0.3% on a monthly basis, that will bring you somewhere towards the 3% marker that some of the Fed speakers talking about, head towards 3% year-on-year by end of this year. So that's where the thinking is. So the extreme case is that if it goes up to a huge number for the month-on-month, the whole trajectory is going to change. That's where your expectation for the Fed funds rate and also for Singapore interest rate as well and other interest rate, that will change dramatically. So there's something to watch carefully when we receive the report. What is there to look for? One of the key things, look at the month-on-month number. That will tell you. For example, the Fed say that, oh, it's going to hit towards 3% by end of this year. That's where your month-on-month ought to be, around 0.1, 0.2, 0.3%. Anything bigger than that, we're in totally different territory. All right, so something to think about when you see the report, right? And that will drive the Fed behavior and expectation, and also financial markets will react accordingly. And that's the reason why the volatility is not going to end because, oh, the Fed is going to slow down, the Fed is going to pivot. It's not going to be so straightforward. So it's something to watch out for. All right, then the next R, so there's interest rate. Then the next R is the recession. This is the same factors that will be, similar factor that will be driving the Fed's behavior as well. So when we talk about recession, it has something to do with the Fed's, one of the Fed's objective, your labor market growth objective compared to the price objective, right? So they need to balance these two. So if this recession story goes too badly, so the Fed will have to react in a certain manner as well. So the one that I want to share with you here for this recession indicator, there are many of probability out there. One of the things that I find quite interesting about this SAM indicator, this SAHM is a person's name. It's a Fed economist who devised this probability of recession. It's a lady, Claudia Sam. So she devised this recession indicator based on unemployment rate. So the idea is that if the unemployment rate moves 0.5 percent point, 0.5 percent point, compared to, okay, you can see a lot, you can see the details from the link, but I just want to cut the story short because of time. Just think about if the unemployment rate moves 0.5 percent point above or higher, then the US is probably in some kind of recession. All right, so that is, that's the premise, or that's the idea of looking at unemployment rate. So using this indicator, apparently, this indicator is very accurate in terms of pointing out or indicating the past recessions over the past, I think, 50 years or so, either at the start of recession or in the middle of recession, right? So very, in terms of accuracy, is quite high. So you want to take a look. So every month, you receive the non-farm payroll report, right? You see the US non-farm payroll report. So one of the things, not so much of, oh, how many jobs, 200,000, 300,000 jobs created. The thing to watch is the unemployment rate. For example, the latest one came down, right? 3.5% from 3.7%. It actually came down. So it means that the labor market is still strong. So there's something to watch. So if we continue to move higher, all these layoff notices that have been given from Amazon, even Goldman Sachs and all that, so they will have some impact on the unemployment rate. So when you receive the non-farm payroll report every month, one of the indicators you need to watch is your jobless rate for the US to give you some idea of where this recession story is going. So our expectation, our call is for the recession to happen sometime before the middle of the month, middle of this year, 2023, most likely first quarter or so, and likely to be a shallow one and a shallow one, soft landing kind of recession, because in the absence of a financial crisis, in the absence of a problem in the financial sector, most likely it's just going to be a business cycle kind of a downturn rather than a crisis sort of a problem. Okay, so again, I think these indicators will drive behavior for the Fed and also expectation for the Fed, and then your financial markets will react accordingly, and that's where all the volatility will come in. So watch unemployment rates for the recession indicator. Of course, you can look at this inverted yield curve, right? You can look at all other probabilities from the Fed, from Bloomberg, and so on, to have an idea of where this recession story is going to go. All right? So, so the R, another R, after your rates, your recession, another R is the Russia-Ukraine. Nothing we can say a lot about this. It's a war going on, loss of lives and property damages and all that. But unfortunately, it's out of control. But we need to see the kind of impact on commodities market. Right, from the commodities market last year, you saw, in terms of the energy prices, food prices, all the impact. So again, if things go bad on that side, if things go really bad in Russia-Ukraine conflict, so they will have some implications on your commodities prices as well. So again, risk management, very important in this case that we need to pay attention to. All right, return to normalcy in China. That's a bit more of a structural kind of R that we are going to go into. This is return to normalcy or a recovery in China. Right now, a bit of all this bad news or a lot of all these scary stories coming out of China, overwhelming the healthcare sector, being overwhelmed, hospitals, etc. But I think China is still going through something that we had gone through before. On the left-hand side, that's the red line is for Singapore infections waves. Right? Singapore infections wave, if you remember last year, just after Chinese New Year, there was some days our infections in Singapore, new infections in Singapore for COVID-19 actually went up to as much as 20 over 1,000 per day. I don't remember those days. Now it's down to about 700, 800 per day on average. Right? You remember those days? So these are the waves. So typically it takes about 2-3 months for the wave to start and then subside. You can see the cycle. This one is around April when we open up. Then after that, there was another wave after with tens and thousands of infections per day. So China, of course, the numbers now, they don't track like Singapore. They don't track the COVID-19 cases numbers anymore. So you can see that those available numbers also show some kind of waves going through in China. And the report that I saw yesterday about this province in China, in Henan, or Hunan, or one of the provinces, 80 over million people, the number of infections, or the infection rate, according to the official statistics, is already up to 89%, 90% of the population infected. Right? So there are waves that are going through in China. So just like us, I think after the waves have subsided, I think things will get back to normal. That will be good for Singapore. Right? That will be good for Singapore. So these are the things that we need to watch out. In terms of, I think, recovery, I think for China it's going to be quite challenging for this quarter, first quarter, and last quarter as well, 4Q 2022. And first quarter, because of all these infections, people staying home, supply chain may be affected, and employees absent because of infections, staying home. So all these activities will be affected to one extent to another. So we expect activities to be slow in the first quarter and then pick up in the second quarter of this year, right? Because a low base also helped with that with the recovery as well. Last year, second quarter was a really low base. So for the full year, we expect growth to return to a normal sort of a range of 5% for this year. We actually upgraded our outlook for China earlier this year from 4.8 to 5.2%. So we are positive in terms of the outlook, especially in the second half for this year. And that will be good for Singapore and good for the region as well. Right. All right. So that's the recovery in China. So I'm going to the last bit for the last 10 minutes, a bit of time on what I think this our Fred earlier this morning also talked about in terms of connectivity, right? Deglobalization, regionalization, and this is a regionalization. Look at this news clip from TSMC, Taiwan Semiconductor Chairman, what he said about globalization. Right? Globalization is dead, almost dead, if not dead already, and free trade is also almost dead. He said this at the opening of at the starting of the construction of his factory in the US, in the open forum. I'm sure he's saying it in a sad manner, not rejoicing this development, right? Because he knows that in order to be competitive, you're cost competitive, you need the engineers and the talent, etc. The place for TSMC to build the factory in the US maybe not the ideal place, right? But unfortunately, he has no choice. He has to move there because of all this US-China tension that Fred talked about this morning. They have no choice because of politics. They have to move to this location to set up the factory, billion-dollar factory, right? So in this background, deglobalization, regionalization of supply chains, that will be continuing to happen since 2018, the US-China trade tensions. All right, so what are the implications? What are the things? What are the shifting sands? What are the numbers that we can look at? I have two charts to share with you, two sets of numbers to share with you here for trade. The first one on your left-hand side, is the US imports from all over the world, right? What is the share? The numbers here are the share in terms of total US imports. The number one, of course, US buy a lot of stuff from China. Right? Buy a lot of stuff from China. How much? About 17% share of US imports came from China in the latest, I think, 12 months, latest year to date, 17%. But if you compare to 2016, look at the column 2016, when Trump came to power, the share was more than 20%, 21% in fact. So there's a 4% downshift through the years from imports from China in the US. So US is buying less from China. And if you look down the list, Mexico, Canada, those are the big suppliers because of the US-America Free Trade Agreement, right? The North America Free Trade Agreement. So no surprise there, about 14% or so, no basic, quite stable. But take a look at number 4. That's ASEAN. All the countries, the 10 countries around Southeast Asia in our neighborhood. Look at the share. From 7%, shift to 11%. So there's an upshift of 4% point. US is buying. So that means the flow, you can think about the flow shifting from China to Southeast Asia and then on to the US. So there's something, all these shifting sands, they're happening under your feet. If you're not careful or you're not aware or you're not paying too much attention, that will miss opportunities for you as well. So this is what's happening here. And if you look further down the list, even more interesting, there's a Vietnam there. Right, take a look at Vietnam. I think it's somewhere after Germany. Used to be about 1.9% point, 2% point. And the share has doubled to 4%. So when people talk about supply chain shifts, that's what the numbers are telling us as well. Right? Sometimes it's very hard to figure out, is supply chain shift, regionalization, is it happening? And the numbers are showing us that is taking place already through the year. So for your companies, your investee companies, etc., so these are the real numbers that we can look at to validate, to verify. And then on the other side is, on your left-hand side is China. Where is China exporting to, right, through the year? Again, you can see that China's biggest market is the US. Still biggest market, but not as big as before. From 18% point in 2016, now 16% point, so a drop of 2% point. So where is it selling to? Where is China exporting to? Go down the list again. Number 3, that's where ASEAN, the 10 countries in Southeast Asia. From 12%, then upshift to 16%. So there's a 4% shift again. So China is doing more trade with us in this part of the world. So part of it, we are a huge market in Southeast Asia. Part of it is because of the US-China trade tensions that we need to pay attention to in terms of regionalization, supply chain shifts. Right, so this is what is, I think the numbers are showing us. And this is for trade and for investment as well. Take a look at the investment. Who is the biggest? When we talk about foreign direct investment, it means people, companies investing to build factories, to build plants, all other things. All these are structural stuff, not your hot money flows. So there's a FDI. Look at the US. It's very interesting. 370 billion moved into the US in 2021. In 2010, that's about 200. And you need to contrast that with what? You need to contrast that with EU at the bottom, near number 5. The numbers totally reverse. So what happens is that EU used to receive a lot, not so much the US because of all this offshoring. Now, your nearshoring story coming back, or onshoring coming back, or reshoring coming back. So the FDI, because of government policy, not because it's competitive or anything. So the flows, again, going to the US. But the other candidate that is benefiting from these flows is ASEAN. Again, the FDI flows going to ASEAN continue to be very strong. A huge increase, 100 over billion in 2010, just 12 years ago, 175 billion. So this is the kind of flows that we are seeing, the trade flows, the investment flows. And on the left-hand side, a bit more breakdown, where this money is going to. Right? Singapore is the number one place for these flows to come in. Of all the 75 billion, close to 100 billion came to Singapore in 2021 because of our regional position, because of our regional financial status. So this is the kind of thing that I think the bank, the UOB, is able to connect with our ASEAN connectivity story, right? With our presence in many parts of Southeast Asia, either in the retail side or in the wholesale corporate banking side. So this is the kind of story that we are seeing, and we are also connecting with all our customers in UOB. But if you look at those are direct flows, who are the one benefiting? The direct flows. Look at Indonesia and Vietnam. Among the countries, going straight to those locations, right, direct, without going through any middleman. That's Indonesia, huge jump, and particularly Vietnam. Look at Vietnam, almost doubled from 2010, the number. So again, these are the numbers that will verify and that will tell you to validate the talk about regionalization, the talk about supply chain shifts. All right, so these are kind of thing. And where are the sources coming from? All these flows, right, coming in, where are they from? Actually, if you take a look, number one is from the US. So US coming to Southeast Asia for their friend-shoring activities. So instead of going to China, you go to Southeast Asia, right? Friend-shoring activities. Okay, so these are the kind, and then China is the main one, but it's not as big as the US. And then, of course, Japan, Netherlands, and all other non-traditional sources as well. And where do these money go to? This money, they'll go to financial sector, leasing companies, one of them, and the other one is manufacturing, is a huge beneficiary of the investment flows. Right? So these are the activities that are taking place. And people think about, oh, a lot of money going into real estate. Actually, yes, but in terms of ranking, it's not as big as the other two. All right, so that's a story. And of course, the reopening of our borders in Southeast Asia and China will benefit us tremendously. For example, Thailand. So far this year already, 9 million, 10 million visitors into Thailand. Right? I'm sure some of you here have already visited Thailand and other places multiple times, right, since the reopening. Okay, so this is the kind of visitor flows that we need to pay attention to. 9 million for Thailand, for example. At the peak, 2019, 40 million. So Thailand and even Singapore, so far we only received about 5 million visitors. At the peak, it's 20 million visitors that came into Singapore. So we are only operating at about 1/4 of our capacity. So can you imagine the numbers continue to flow in from China? Once things are more stabilized, things are more steady in China. All right, so in terms of our activities, I think things are looking quite positive for all the developments for this part of the world in ASEAN. So we should be, I think, a bit more optimistic in terms of our outlook, and therefore, in our chart here, all the numbers that we line up, these are our forecasts, our team, the research team at UOB. For example, in Southeast Asia, this year, you probably can see about 6.5% growth for this year. A bit slower than compared to 2022, but nonetheless, is something that we should be, I think, looking forward to in terms of this outlook. Of course, Singapore is not going to be that fantastic because we have quite a strong growth last year, 3.6% in 2022, and likely to be slower this year because of manufacturing. Our exports a bit of a situation there. All right, so, but for the US and the rest, a bit difficult year for this year, so we do have to prepare for that. Risk management, again, very important if you are selling to those markets. And of course, China, just now mentioned, 5.2%, I think should be able to achieve for this year based on what they have been announcing so far. All right, finally, conclusion. I only have 30 seconds, and this is a conclusion. Again, the five R's, right? The first 3 R's, market volatility, get ready. Do your things. Get yourself in terms of risk management. How do you manage your risk? Important to take a look. And the shifting sands at the bottom need to be positioned to take advantage and all those opportunities that might be coming through. For example, our colleagues here, Fred Chin's team will be able to help you to look at all these developments and opportunities that are available out there as the sands continue to shift under our feet. All right? Okay, that's all for me, and I would like to pass on to the next panel for more exciting discussion, etc. All right, okay, thank you so much, and thanks for having me. Thank you.